This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
Now, connected with rollover relief, it may be that when you roll over the proceeds from one qualifying business asset into another, you actually roll it over into what's known as a depreciating asset. Now, this by definition is one that has a life of less than 60 years, or it is fixed plant and machinery. Now, there's a note there. You will only be examined on fixed plant and machinery and leasehold property with a life of 60 years or less. So those are the only two assets that you are going to come across. Now, instead of deferring, you postpone. It's slightly different. So if the new asset is a depreciating asset, then the gain deferred is not deducted from the cost of the new asset. So there is no base cost. Same principles apply as with rollover relief. It is instead postponed until the earlier of these three things. And I have seen questions where you have to write out that rule. Okay, that is the rule, and you may have to write it out. So the earliest of the disposal of that asset that you've bought, the date it ceases to be used in the trade, or the full limit is 10 years. So bad relief is only available if any remaining gains after the relief in relation to the disposal of the whole business. So let's have a look at example number 7. Charlie purchased a freehold factory in May 2011, so that's our cost, and used it in his trade. Okay, ticks is the box. June 2023, he sold it, so that's our proceeds. And then he bought, there you go, a 55-year-old leasehold property for 600,000. And in February 24, he sold that for 640,000 and moved into rented premises. Calculate the gain arising on the disposal of the factory in June 23 and the leasehold factory in February 24, assuming that he wants to defer all the gains as soon as possible. So let's have a look at how that would work. So did he reinvest all the proceeds? Yes, he did. He reinvested all the proceeds. Okay, into the thing. So all of it is held over. You notice the word I've used there? Held over and not rolled over. Either until it is sold, or it ceases to be used, or 10 years. So we've got June 23. That gain then is chargeable in 23-24 because it was sold in February 24. So the gain is proceeds less cost equals gain. So that's what's going to happen here. But then we have the leasehold factory. There's going to be a gain on that of 640 proceeds less cost equals gain. And he can't have business asset relief, sorry. He can't have bad relief because he didn't dispose of the whole of his business. So that's the sort of thing that you might get, very small kind of question. So section 5.3, acquisition of a new non-depreciating asset. So if a new non-depreciating asset is acquired before the deferred gain becomes taxable under holdover, then rollover relief can be claimed. And the capital gain on the original asset is then rolled over into the depreciating asset, and the depreciating asset is therefore effectively ignored. Now, this can get complicated, okay, and it's unlikely in an exam, okay. So basically what happens is you sell the non-depreciating asset and you buy one like the one in example number 7, but then you go on to buy a non-depreciating asset. So basically you ignore what's happened in the middle. There are no examples for this. This is how unlikely it is to turn up. So let's move on to gifts. Now, this is gift relief is available where the donor, that's the person who is giving, has a tax liability. However, as they are gifting it, they have not received any funds on which to pay the tax. So they are treated, again, connected persons, if you need to look at that in a previous chapter, to all at market value. The donee, the person receiving the gift, is treated as having acquired it at market value. And we have gift holdover relief, which allows the gain on the gift on certain assets to be held over. Again, it's a deferral relief until the asset is sold by the donee. As a result, there is no gain or a reduced gain on the donor at the time, because they either didn't receive any funds or received a small amount of funds as opposed to the full market value. And the gain arises on the donee later, and he or she will be taxed at the appropriate rate at the date of disposal. So we have an example here, example number 8, where David bought an asset in 2018 for 60,000, and then he's gifted it to his son when the market value was that, and it qualified for gift relief. So let's have a look at how that works in practice. So we are looking at David, who made a disposal in September 23. What are we looking for? We are looking at proceeds minus cost equals gain. Now, because this is a not at arm's length, we don't use that. We use the market value because it's connected persons. £100,000. The cost from the question was £60,000, giving us a gain of £40,000. Now, because he's fulfilled all the criteria, we get gift relief. Now, just to point out, I am writing these things out in their abbreviation, P, M, V, C, G, G, R. Do not do that in the exam. I'm doing it now because writing out takes time and you're just watching me write. So I'm saying, obviously, what these things are at the time, but please don't do it in the exam. So, gift relief in full, and he has deferred his gain completely. Now, he has then given that to his son Tommy, and Tommy is deemed to have received it at its market value, which was £100,000. However, there is a gain rolled into it, so gift relief needs to be deducted. So the base cost of this asset is £60,000. So it's the same process as with rollover relief. Now, the problem with gift relief is David made the gain, Tommy's paying the tax. So you are going to have an election signed by both of them to say that Tommy not only receives it at market value, but is quite prepared to pay the tax when that asset is then sold. So when a claim for gift relief is made, the donor may lose his entitlement to a business asset disposal relief. If the asset qualifies, then gift holdover relief, if claimed, it's applied before that relief. So sometimes you may have to decide which one is the most appropriate. So this relief is only for individuals and it's not automatic. You must claim it. Both of them must sign within 4 years. Now, what assets can you have gift relief on? Because you can't have it on everything. So you can claim it on the following assets. There is a list here. Assets used in the trade of the donor, where she's a sole trade, he or she is a sole trader or a partnership, or if it's their personal company. Okay, if it's their personal company. So this extends the relief to assets owned by an individual but not used directly for trade purposes. And shares and securities of trading companies, providing they fulfill the following conditions. These are all rules that need to be learned. Shares are not quoted on the stock exchange and they are the individual's personal company, which is what you would expect. This is a family business. Family business needs to be go from one generation to the next generation in order to be able to perpetuate the business. And in order to be able to do that, the parents need to give to the children without a huge tax liability. So if it's a pure gift, that's what happens. Now, it may be that it's called a sale at undervalue. So say, for example, I own a business that's worth £300,000. Now, I'm going to gift that to my son or my daughter. I don't need £300,000. They don't have £300,000 to give me, but I want to retire and I want to get rid. So I could gift it. However, I would like to retire to Spain and I need £55,000 in order to be able to do so, to buy myself a nice property. So I am selling it to them at undervalue simply because they are my children. So that's the principle here, where there is an element of gift, but there is a sales and there are some proceeds. So the gain and the gift relief calculations. Little bit of a twist here, because remember, with rollover relief, if you reinvested all the proceeds, no cash, you pay no tax. Gift relief, no cash, you pay no tax. With rollover relief, if you retained some of the proceeds and you didn't reinvest all of it, you pay tax on it. Gift relief, if you have a sale at undervalue, in other words, you have a measure of proceeds, you will pay tax on it. Now, it's not exactly the same as rollover relief, which is just the figure. We have to do an actual calculation, what actually happened, to work out what the actual gain would be if we didn't use market value. And that actual gain is the figure that goes at the bottom. Then you work out the gift relief. So that's my explanation. Let's go through the notes. The market value at the date of the sale at undervalue is used as the proceeds in calculating the gain. So we use market value less cost. Okay, now if actual proceeds are received, okay, then that is greater than the original cost of the asset, then gift relief is available, all of it, and it's treated as an outright gift. However, if proceeds received are less than the original cost, then any excess is charged to tax and you get gift relief on the remainder of it. So we've got a brilliant example here which will help us to see how that works. And I'm going to show you the model answer because it just explains it really well. And I can kind of show you the whole thing and then sort of explain the various different bits. So Richard acquired a 25% holding in an unquoted trading company. That is the cost. As you go through every question, this is what you're looking for. He is an employee. Now, he sold the shares to his son for $85,000 when their market value was 200,000 and they've claimed gift relief. What is the gain incurred by Richard and the base cost of the shares for his son? So let's have a look at the model answer for that. So here we can see that Richard has a chargeable gain on the shares sold at undervalue. And you notice how that's the heading. So the examiner can see that is what you have done. Market value less cost equals gain. And we've done that from the question. In every single question, you're looking for proceeds and or market value. Cost equals gain. Now the gain is going to be deferred. Okay, the gain is going to be deferred. So the capital gain of 140, you see here, this is what actually happened. We received 85,000. That is the actual cost, and that is the figure that needs to come off the gain, which means that is the figure that is taxable, and this is the rollover figure, sorry, the gift relief figure, which is the balancing figure. That's the figure we've calculated. So his gain, and it asked you in the question to work out his gain, less AEA is 19,000, and he's going to pay tax at 10%. Richard's base cost is therefore the market value of the shares, less that rollover figure, the gift relief figure, which gives him a base cost of 85,000 as and when he decides to sell it. Because there's an election in place, that means that Richard's son's prepared to pay the tax, then he will obviously pay that as and when.